Welcome everyone, it's time for an update. Of course, we're going to be going over the market sell-off, right? This is a big sell-off. Things are down. The Dow Jones is down 1%. The S&P 500 is down 0.97%. And the NASDAQ is down 0.71%. So the entire market across the board, every type of company is basically selling off right now. And there's a lot of content created around sell-offs. And I want to talk about kind of this meta content that always seems to be created whenever the market goes down a little bit. We're going to be talking about that. And then one other thing I want to go over in this video is this right here. This is a letter written in 2005 called Deconstructing the Investment Case for Costco Wholesale. This was from an investor named Nick Sleep. He was a former hedge fund manager. He was very successful. He crushed the market, but he also was very good at identifying the long-term qualities of a company. What will make a company actually succeed? And in this letter, he talks about how simple heuristics that investors use, which heuristics are like simple tools that we use, like PE ratio, price to sales, the future projected quarterly growth of a company. Many of those can actually be misleading. And he highlights how they misled investors with Costco, mispricing this opportunity. Because Costco doubled from the point this letter was written. Costco has doubled the return of the S&P 500. And he predicted that. He said that it was worth twice as much as investors are paying for it. So he very accurately predicted the outcome of Costco. And in this deconstruction, he highlights how he was able to do that. So we'll be going over that as well in this video. So we have a lot to get to. As always, if you enjoy this type of content, you can help me out by liking the video. You can also consider subscribing to the channel. For you that don't know, the bell icon just makes it so that you get an alert when I post a video instead of counting on YouTube to recommend it to you. So you can hit the bell icon as well. And then lastly, if you really like this type of content and you want to bring your membership to the next level, you can consider joining the Patreon. If you join it right now, you'll get 3 weeks for free. So a free trial, you can try it out. There's no risk. It's cancel anytime. Now let's go ahead and jump right into the big news. The market is in the red. And most of the indexes are in the red by nearly 1%. You know the drill. You know what happens when you see this, when you see the red across the board, when you see the entire market. This is the one-day performance of the S&P 500. Look how much red there is. You know what goes on. This is what happens inevitably. You're going to see a lot of content that is fear-mongering content. And I mean fear-mongering by flames in the background, shocked faces, titles like the market's flipping upside down. And this isn't even something that's specific to YouTube. It's true that a lot of YouTubers create a lot of shocking content because you have to get those sweet, sweet clicks on every video. And if you have very shocking titles and shocking thumbnails, you're going to get those clicks. But YouTube is not the only one doing this. We can look at MarketWatch. Here is the title today for the head article in MarketWatch. Bond yields and tech stocks echo, quote, extreme anomalies. Extreme anomalies of dot-com boom, says Morgan Stanley. I kid you not, that's the title when the market goes down 1%. They're comparing it to the dot-com bubble now. Were they running this type of title a week ago or a month ago? No, because the market was in the green. If the market had surged 2% today, you better believe that MarketWatch would not be running this title. They would have something different, like here's the 5 growth stocks you need to be buying right now. Buy, buy, buy. But now that the market's in the red by 1%, they'll run this type of title. This is what I see with financial content. It shifts and gravitates towards whatever happened most recently. Now, we don't do that here. We're not reactionary buyers in the market. We'll look for opportunities. If there's a big sell-off, I'll be buying stuff in my portfolio. But it's almost always better to be focusing on the long term, to be zooming out and looking at the big pictures with your stories and your stocks. For instance, if we go back to here, if we look at this chart right here, this is again the one-day performance of the S&P 500, broken down into every company. You can see them here. Across the board, it's pretty red. We have a couple outliers. Costco's in the green, Amazon's in the green, Tesla's in the green. Most companies are in the red. Now, this can be shocking and concerning if you wake up and look at how much money you've lost in the past 24 hours, right? Just from the morning. Let's go ahead and look at the 1 week performance. It's a little bit different of a picture there, right? If we go back just 5 days, this is including today. So this is the 1 week performance, including today. And this is how green the market is. Now let's go back 1 year. Let's go back just 1 year. I can barely see because of how much green there is. It's almost blinding to me. You can see it on my face, the amount of green in the market. almost everything is up. You have Apple in the green, 55%, Microsoft up 34%. All of big tech is heavily in the green. All of the financials basically are in the green. We have a couple companies that are outliers that have had particular struggles like AT&T and Intel. Those ones have struggled. But look at how green the market is if you go back 1 year. And this is what a lot of the content creation doesn't focus on. So again, we stress the importance on this channel of looking at your companies as long-term compounding machines. Don't view them as ticker symbols that trade up and down day to day, even though they do. That's the easy way to view them. If you put your home on a market like the stock market, it would also tick up and down every day, but most people's houses have gone up over the past 10 years. It's just the way that things work. Now, if we look at my portfolio, this is the story fund. It has a current value of $96,000, $16,000 is in gains. If we compare the market to the story fund today, we can get a little bit of insights. It's down a little bit less overall than the rest of the market. We can look at what companies are currently in the red and which ones are in the green. We have Amazon in the green, Peloton in the green, Snowflake in the green, Adobe, Teladoc barely, and CLTD barely. Then if we look at the biggest losers today, we have DoorDash, Shopify, Square, Visa, Facebook, and so on and so forth. The majority of the companies are in the red today. Now, what this leads me to believe is that the narrative that the market is selling off today because of COVID 2.0, because of the Delta variant, I think that's inaccurate. I think that's a false conclusion. The reason that I say that is because if that was the reason the market was selling off, why would DoorDash be in the red by 3.5%? Why would Shopify be in the red? These are companies that benefit if another pandemic happened. These are the so-called pandemic beneficiaries, right? These are the companies that have really excelled during that time. We have some other companies that are in the green that have excelled, like Peloton, but I just see no correlation here. I don't think that this sell-off has anything to do with the Delta variant. And in my opinion, I think that the Delta variant is not as much of a threat in terms of the stock market as people are making it out to be. I think that it will be much less impactful than the original coronavirus because we know about it, we know how to handle it, we know what companies do and how they react to it. So I think that there's a little bit less risk in the Delta variant than there was with the coronavirus. So looking at this overall, I'm really not concerned about this sell-off today. It really doesn't concern me. If you look at your portfolio and you say, well, it's up today, it's down tomorrow, what's going to happen in the next week? I think that's a very confusing and difficult way to invest. Of course, I look at my companies as long-term compounding machines. The value in 5 to 10 years will not be determined of whether or not we have a good closeout this week in the market, or whether or not the S&P 500 is up or these companies are down at the end of this week. What's going to determine the long-term value of these companies is their earnings growth, their revenue growth, their market share, how big and profitable of companies these are in 5 to 10 years. Ultimately, that will determine the price of these companies. So what I'm trying to do is identify the characteristics that will lead these companies to success over the next 5 to 10 years. I don't care too much about the weekly trading and what's going on in the market today or tomorrow. Now, one thing that I came across that I think highlights this very well is an investor letter that was written in 2005. It's not really an investor letter. It's actually called the Deconstructing the Investment Case for Costco Wholesale. So this investor named Nick Sleep, he wrote this in 2005. Since then, Costco has over doubled the performance of the S&P 500, and it's done that with less volatility. And he was able to identify what Costco had that separated it from other companies. And he put a huge amount of his fund in Costco. He had over 10% of his fund in Costco. Another company that he picked, by the way, was Amazon. So he was very good at identifying good companies that would compound for long periods of time and that were perceived to be overvalued, but were actually undervalued. In this letter, he highlights what he calls heuristics that are misleading. Heuristics are like little things that you can use to reach outcomes. They're little tools that we use. So a PE ratio could be a heuristic, a price to sales, a revenue growth chart. All these little tools that we can use, those are heuristics. And he highlights with Costco how many of those heuristics were misleading to investors. What is it about growth stocks that doom them to failure? In other words, why is Michael Goldstein's growth stock failure rate and our shunning of Dell normally right? The answer is that success encourages competition, and capital flows into an industry to compete away excess returns. Like all heuristics, this works most of the time. He's saying that whenever you have a profitable endeavor and it has excess profits, you're earning a lot of returns with it, capitalism means that other companies will come in and they'll see those excess returns and they'll compete away those excess returns. They'll lower your margins by competing with you. Now, he says, we can all think of businesses that were super profitable for a while before the competition caught on. But what of those that don't fail? Michael Dell succeeded by keeping costs low and passing back his scale benefits to the buyer of his PCs. By the time the competition had matched him in pricing, he had moved on and on and on. He says Amazon.com may be following this path as well. So the first point is that whilst Costco continues to recycle cost savings to the consumer, it is lowering the probability of failure. So this is the big picture here that a lot of investors that they didn't realize with Costco. The fact that they lowered prices and took in less profits for years actually lowered their probability of failure and made it more likely that they are going to be a successful company. He says, so what heuristics do investors incorrectly apply to Costco? Why might the shares be mispriced? Why is Costco mispriced right now? Keep in mind, this was back in 2005 when this was written. And just like today, Costco was considered overvalued in 2005. Heuristic 1, the company has low margins. That's typically something people say as a negative thing for a company. If a company has low margins, that's a bad thing. A high margin company is a good thing. He says net profit margin is 1.7% compared to Walmart with 3.6% and Target with 4.2%. So Walmart and Target all have higher margins than Costco. He says, true, Costco does have the lowest margins, but that's the point. The firm is deferring profits today in order to extend the life of the franchise. Of course, Wall Street would love profits today, but that's just Wall Street's obsession with short-term outcomes. Heuristic number 2. This is the second thing that people got wrong with Costco. He says, quote, it's expensive at 24 times earnings. It's an expensive company. Really, net income is a small residual. As discussed above, the firm could earn Walmart margins by taking pricing up a little, in which case the firm would have 11 times earnings, because if they doubled their margins, their earnings would double, and then they would have 11 times earning multiple instead of 24 times. So all Costco had to do to increase their margins and earn double as much was take their pricing up a slight amount, just to what Walmart was at. That's all Costco had to do, but they didn't do it. And he says, but would it be better business as a result? We think not. If it allowed the competition to catch up. So by Costco keeping their pricing super low, they ensure that nobody else can catch up to them. Nobody else has any profits to earn. They would likewise have to run at a loss in order to catch up to Costco. And then finally, number 3, Costco has a cost problem. Costs have risen as a percentage of revenues in the past few years due to the expense of warehouse and distribution systems associated with their next phase of the firm's growth, and the cost of employee benefits and insurance. If you're not aware, Costco pays their employees very well. They pay them above what Walmart does and Target does, and many investors look at this as a negative thing. They actually look at overall the cost of running Costco as a negative thing. The fact that Costco puts first their customers by having extremely low margins, they could inch up those margins and give that money to shareholders through dividends or whatever. They put their customers first. That's something that Costco does. And then they put their employees second. And then in third place, you have the shareholders. Now, when you hear about a company doing that as a shareholder, your initial reaction may be, that's not good for me. They're putting their customers first and their employees first, and then they're putting me into the back of the line. When I'm the shareholder, I'm the owner. This is exactly what your company should be doing. If they put the customer first, if they put the employee second, and then you last, you will benefit from that. The company will do better overall in the long term than the short-sighted view of putting the shareholder first, reaping as much profits in a short amount of time as possible, and giving all of that to the shareholders. That is how companies boom and bust very quickly. That's not how companies grow over long periods of time like Costco or Walmart. Those are companies that put the customer before the shareholder, and that's at the benefit of the shareholder. So when I look at these 3 examples, I still see investors using this type of logic all the time for companies today. How many times have you seen people rule out an investment because the margins are low. They look at it and they say, it has low margins. It must not be a very profitable or powerful corporation, right? Because the margins are low. If they were powerful, they could raise their margins up. Well, that's not really the case. Costco is a very powerful corporation. Obviously, it's been a massive success, and they've done that by keeping their margins low to rid out competition, to make it more difficult for different retailers to compete with them. Amazon has done the same thing. They keep their margins low for their long-term success. So low margins is not necessarily a bad thing. The second one, that their earnings mean that they're expensive. Their PE ratio, how many times have you seen that be said by different companies that are not focused on earnings? Costco wasn't focused on their earnings in 2005. They were focused on their long-term success. If their big focus was to squeeze out earnings, like he points out here, they could raise their margins to what Walmart had, and then they would have 11 PE ratio instead of 24. So this is another thing that I see misapplied all the time. And then finally, with the third one, a lot of investors look for companies that they call shareholder friendly. And that usually implies companies that are looking out for their shareholders above their customers and the employees. That's not what he looks for. He looks for companies that are customer friendly, that are employee friendly, and they put the shareholders in last place. Costco has always done this. They've always put the shareholder in last place. They put their company first. They put the employees first. They put the customers first. So that's the relationship you should have if you want to have long-standing success. So when I look at my story fund, I try to focus on companies that have the same attitude of Costco. Companies that are willing to put aside immediate gains right now and focus on the long-term success of their company to minimize the chance of failure and to focus on their customers and their employees. There's some companies I could highlight as examples of that. I think Netflix is a good example. They put the customer first. They offer very low prices. They haven't added in advertisements or different gimmicks to milk more profits. They keep their prices low. They offer a ton of value. They put their investors in last place behind the customer and their employees. They also treat their employees very well. So Netflix is a company that I'm convinced is focused on the very long-term picture. And I think that even buying it now at a perceived very expensive price, over time, if the characteristics still work out like it did with Costco, I think Netflix will prove to be a very good investment. So that's my thoughts on it. I hope you enjoyed the episode. If you did, like the video, share it with someone else, and I'll see you in the next one.